Okay, so we'll go now to the second part of the introduction. So we'll discuss about the introduction to investment. So what is investment? So basically this is the action or process of investing money for profit or material result. Investment can also be an asset or item acquired with the goal of generating income or appreciation. And when we speak of appreciation, so basically this is just the increase in the value of the asset. Now, along with the investment, of course, we have the principle of portfolio. Now, what is a portfolio? A portfolio is a collection of financial investments like stocks, bonds, commodities, cash, and cash equivalents, including closed-end funds and exchange-traded funds. No? People generally believe that stocks, bonds, and cash comprise the core of portfolio. Though this is often the case, it doesn't need to be the rule. A portfolio may contain a wide range of assets, including real estate, art, and private investments. Now, you may choose to hold the manage your portfolio yourself, or you may allow a money manager, financial advisor, or another finance professional to manage your portfolio. Now, plus when we speak of portfolio, basically this is there's also this principle of diversification. No? Later on, we'll discuss about this. No? But when we talk about your investments or your portfolio of investments, it can be different financial investments. No? So good examples would be your stocks, your bonds, your cash. No? But it also includes real estates and other private investments could be. But when we talk about real estates, could be your land, your condominium unit. So those are types of investment. Okay. So portfolio management it's the wisdom of diversification. Now, we've talked about this as well earlier, but basically diversification tries to reduce risk by allocating investments among various financial instruments, industries, and other categories. No? It aims to maximize returns by investing in different areas that would each react differently to the same event. So imagine class, no? So you have, I'm just, um, I mean, for the sake of discussion, imagine you have 1 million and then you put it to ABS-CBN. Then you suddenly here comes President Duterte um, ranting about his experience during the past campaign period. No? So obviously you know what happened to ABS-CBN. But imagine if you have invested 1 million, uh, all your money to ABS-CBN. No? So it would be a chaos for you. So that's basically the principle of diversification. So meaning you should look for different avenues or different investing opportunities and do not just rely on one um, investment. No? So as to make sure that it will, I mean, your money will be safe. No? It will react differently to uh, various situations. Now, there's of course, no, when you're trying to invest, there's an element of risk, no? So there's an element of uncertainty. Now, uh, how you adapt on those risks is really personal to you, no? So it's I mean, there's no right or wrong answer in terms of your risk appetite. But again, uh, for the sake of discussion, we'll talk about risk appetite, but as also as an activity for next week, I'll be sharing this link to you, and then you can check what type of risk appetite you have. No? And so this is a good exercise as early as now, so that you will learn what type of risk appetite you have. No? So what are the types of risk appetite? No? So we have risk averse. No? So you view your savings as a reliable safety net. No? Moving away from risk-free investments would make you feel uncomfortable, as this would reduce this security. So basically, when we say risk averse, these are the people who would rely investing in banks, no? So savings, I mean savings, putting their money in the bank, because and they don't want really to do a lot of things their money, so they simply just put it in the bank and then earn interest from it, no? Yeah. Next, we have cautious investors. So you have grown irritated by tiny interest. No? So this is the next level. No? So level one could be the risk averse, and then we go now to level two, which is cautious investor. Now, you have grown irritated by tiny interest. As you know, just simply depositing or putting your money in the bank will just earn you a very small interest. No? And so for a cautious investor, you've outgrown that, no? So you have come to appreciate that better rates of return are available to those who look further afield. No? So that being said, you want to adopt a careful approach to investing and are particularly hesitant about buying shares with the memory of the most recent stock market crash. You have never imagined you would become someone who lost out in a market crash. You're prepared to accept lower returns if it means avoiding becoming one. So probably this cautious investor would um, have a second thought investing in securities at this stage, no? Especially with what's happening in the securities exchange right now. Most of the stocks are red, no? Most of the stocks are uh, have prices declining. So cautious investor um, might not like to participate in the securities exchange or trading or investing right now. So that's a cautious investor. Now, there is also so-called balance investor. So you see investments to grow your wealth, and you take a long-term view when setting expectations. So by focusing on the destination, you can accept risk of capital losses in the short term. When picking shares or funds, you would prefer to invest in well-managed companies in highly regulated countries. So dun parang you're open to investing. No? So right now, probably this is level three. You're open to investing, but there's still the safety net. No? So you would like it to be still secured. You still have you still value the value of your investment by making sure that you only invest to companies with good reputations. No? So probably these are the investors who would buy stocks from Jollibee, from San Miguel, those types of companies. No? So with good financial background and managed by leaders who are well known in their fields. No? Okay. And the next one is adventurous investor. So for you, investing world is an exciting arena because of its lack of return. You lament holding cash in a safe bank account. You seek the maximum return possible and are prepared to stomach heavy volatility in the markets to earn it. Now, we have this so-called the higher the risk, the higher the return. So, adventurous investor would seek higher return by investing in high risk investment opportunities. So these are um, really people with high appetite for risk. No? So probably these are the people who can still sleep at night despite of markets being down or stock prices going down. So that's adventurous investor. Now, like I said earlier, as an activity prior to our next class, please make sure to take time to check your risk appetite via the questionnaire, via the link that I'll be sharing with you. And then please upload the result of your risk appetite questionnaire, and then we'll discuss that if it's true. No, we'll discuss it next meeting. Now, there's two concepts, no, around securities or equity trading and investing. No? So we have investing and trading. Now let's differentiate one from the other. Investing takes a long-term approach to the markets and often applies to such purposes as retirement accounts. Now, while trading, it involves short-term strategies to maximize returns daily, monthly, or quarterly. Now, um, if we're going to put this in a context where you're trading in a secondary market, no, for example in call financials, uh, people or investors would tend to buy shares from companies with very good reputations. So like JFC or yung nasa PSEI index. No? Um, the intention is to keep it. No? So they're investing money, investing to those, I mean, buying shares from those companies with the intention of keeping it. Now, in the context of trading, these are really investors who would sit and and then really check on the fluctuation of the share price. No? So these are the people who would really buy in bulk, and then when the price goes up, they 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 also sell, no? Um, with really the context of getting money out of it. No? So that's basically how we differentiate investing from trading. So investors are more likely to ride out of short-term losses. So I mean, for investors, it's okay to have short-term losses because the intention is to keep it, no, to keep it, and by studying really those companies, it tends to fluctuate. But then, because of the reputation, because of the stability, also the leadership of those companies, no, really the share prices go up. Now, traders, on the other hand, will attempt to make transactions that can help them get profit quickly from fluctuating markets. Yun nga. Uh, like in the case of, I remember, I think 2 years ago, If you recall Now Corporation, at that time they were there are a lot of speculations where they're really buying to be the third telecommunication company, no? So me share prices went up, and then all of a sudden Dito Corporation, they were announced to be the third telecommunication company, and so the share price of Now Corporation went down. So traders at that time, they were able to get money um, out of the Now Corporation's share price, no? And but then, like I said, these cases, they're very prevalent right now. And then and traders really invest time to study these types of companies, no? Because they're, like I said, they're they're there to get profit, no, quickly from fluctuating markets. And that ends our first session. So I hope you learned something today. I'd like to get feedback and also read comments, no? And also, if you have any questions, you can send me an email, or you can send me a message through Viber or any platforms. So then I'll make sure to attend to you as soon as possible, no? So if you have, like I said, if you have any questions, you can simply send me an email, no? And then I'll try to get back to you as soon as possible, or if not, we can discuss it during the next session. So thank you very much for your time, and stay safe. Goodbye.